This video consists of four major parts: the definition of support and resistance, how to identify and draw support and resistance zones, how to trade with support and resistance, and key takeaways from using support and resistance to trade. Note that there will be some mini quizzes to test you on how much you have understood whatever I'll be teaching you. There's a bonus portion for a subscriber's request on the difference between Hanging Man and the Hammer. If it doesn't hurt you in gaining more knowledge, you can stay till the end. Let's go. Support and resistance are fundamental concepts in technical analysis used by traders to identify key price levels where the market may reverse or stall. These levels are derived from past price action, and they help traders understand where the price is likely to face barriers that could lead to a trend reversal or continuation. Support is a price level where an asset tends to find buying interest as it falls. In other words, it's the price level at which demand is strong enough to prevent the price from falling further. In basic terms, when price moves down and then pulls back, the lowest point reached before it started the move up is now support. When a price drops to a certain level, traders, or institutional investors, see it as a good entry point, which causes the price to bounce upward. This creates a psychological floor for the price. On a price chart, support is usually drawn as a horizontal line at the price level where the price has previously reversed or stalled on the downside. When price approach this level again, they are likely to either bounce off it or break through. A strong support is when the zone has been touched and rejected more than once. A weak support is a zone with only one reversal from its start point. However, the higher the time frame, the stronger the support or resistance identified is. Resistance is the opposite of support. It's a price level at which selling pressure tends to be strong enough to prevent the price from rising further. Essentially, it's the ceiling that the price struggles to break through. When the price moves up and then pulls back, the highest point reached before it pulled back is now resistance. When the price approaches a resistance level, traders may start to sell, thinking that the price will reverse or drop. This causes the price to face downward pressure. On a chart, resistance is drawn as a horizontal line at the price level where the price has repeatedly reversed or stalled on the upside. If the price breaks through resistance, it could indicate further upward movement. A strong resistance is when the zone has been touched and rejected more than once. A weak resistance is a zone with only one reversal from its start point. Support and resistance levels can change over time. If the price breaks through a support level and then retraces, that level may act as resistance in the future. Traders watch for a price to test the level and fail to break through, which would confirm that it has flipped from support to resistance. Similarly, if the price breaks above a resistance level and retraces, that level may act as support in the future. There are other representations of support and resistance, such as trend lines and round numbers or psychological levels. I'll cover that later in another video. Now, let's focus on identifying support and resistance using pure price action. You have to put it in your mind that identifying zones of support and resistance relies heavily on past price action. Identifying support and resistance in the meantime will be confusing for you, and that is very normal. Practice makes perfect. Carefully follow the instructions I give you, and if possible, try to note down some important terms. I recommend the 1-hour time frame as a starting point before advancing to other time frames. I will mainly use the 1-hour time frame so it will be familiar with you when you open your charts. The first thing to know about support and resistance levels is that they aren't always exact levels. In fact, most often these levels are better thought of as areas on your chart. There is no perfect zone. It is normal to be guessing on whether the zone is too small or too big. I will explain as we progress. In identifying support and resistance, we have to know the type of resistance and support levels that appear on our chart. The very basic support and resistance level is the short-term low and short-term high. Short-term low and short-term high are the most recent low and high points in the market. Identifying this is quite easy. These are less relevant to support and resistance as they are less reliable unless either the short-term high or short-term low generated quite a number of rejections to make it a strong zone. For example, these are the short-term low and short-term high in this chart. Can you identify the short-term low and short-term high in this chart? The intermediate support and resistance level is the swing highs and lows. Swing highs and lows are more likely to generate rejections than the short-term high and short-term low. A swing high or low is characterized by A long impulsive or aggressive movement from a high or low, usually characterized by long body candles, or B, a gradual but prolonged move from a high or low. For example, these are the swing high and low in this chart. Can you identify the swing high and low in this chart? A major support and resistance level is a zone with two or more rejections. A short-term low or high and a swing low or high automatically becomes a major support or resistance level if it has more than one rejection. This is what we are actually looking to identify and trade from. For example, these are the major support and resistance level identified in this chart. Can you identify the major support and resistance level in this chart? For short-term lows, short-term highs, swing highs, and lows, a line is placed at the bottom of the wick in the case of a low, and a line is placed at the top of a wick in case of a high. From there, a rectangle is drawn from the line to the edge of the body, and it is then extended. This is easier to identify in a recent market. Try drawing this frequently. It will make you understand it better. Let's identify the major support and resistance levels. This is only identified from past price action where a zone has multiple rejections. Before you even think about the concept of support and resistance, just mark a zone that has multiple touches across a horizontal line. Turn a blind eye and try to filter the noise. This can be tricky, but don't worry. It doesn't have to be perfect. Just make sure there are multiple rejections as the rectangle cuts across. After marking a zone, your knowledge in support and resistance will let you know which and when the zone is a support or a resistance. As you can see in this example, the zone has multiple rejections. As price reached this zone from below, it was a resistance. When price broke the zone, it became support to continue the trend. And in this example, price reached this zone from above, which is our support area, and bounced back. Also, wicks help to identify support and resistance levels easily. To spot a resistance or support area, identify wicks that cuts across a horizontal zone and draw your marked area. If you notice multiple rejections at the area, then that's your support or resistance. One may ask, if price broke a support area and it became resistance and moved down and came back to the resistance level and broke it, does that become support again? The answer is yes. Listen to this carefully as it can guide you. If price is vividly below your marked major level, that zone is a resistance. If it's above your marked area, the zone is now a support. So if the market keeps shifting, you also keep adjusting. Trading support and resistance is a patience game, as you always have to wait for price to get to your zone before you react. There are two strategies when trading support and resistance. We have the bounce and the break strategy. The bounce strategy focuses entering trades when price bounces off a support or resistance, and the break strategy focuses on entering trades after price breaks a support or resistance. In trading the bounce or break, there are two types of traders, of which you can choose what you want to be. The first kind is the conservative trader, and the other is the aggressive trader. This is how a conservative trader trades. The conservative trader trades the bounce only after a candlestick confirmation. For example, in this chart, when price got to our zone, the conservative trader waited until he got a candlestick confirmation before he entered the trade. With the break strategy, the conservative trader trades the break by waiting for a pullback after the break and entering with a candlestick confirmation. Now let's move to the aggressive trader. The aggressive trader trades the bounce by entering the trade once price approaches the support or resistance level. For the break, the aggressive trader enters the market once price breaks the support or resistance level. The conservative trader is good for risk management, but sometimes price may move away from a support or resistance area without a vivid confirmation, so be prepared to miss some trading opportunities. The aggressive trader will be able to catch trades faster and execute trades that a conservative trader may miss. However, this type of trading is based on hope that price indeed moves to the direction you're guessing, which is a bit bad to becoming profitable. Well, can you combine them? Yes. You can trade the bounce as a conservative trader and trade the breakout as an aggressive trader when the market vividly shows an impulsive move. However, there are ways that can help tilt the odds to your favor regardless of the type of trader you are. Trading from resistance in a downtrend has high probability to work than trading a support in a downtrend. The same goes for uptrend, where a support is likely to work than a resistance. Simply put, trading from support in an uptrend has a high win rate, and trading from resistance in a downtrend has a high win rate. The target profit in going against a trend from a support or resistance area should be small than the target profit set for going with the trend from a support or resistance area. In going against the trend with a support or resistance, your target should be 1:3 risk-to-reward ratio. In going with the trend, your target profit should be the swing low or swing high depending on the trend. Stop loss should be outside the support or resistance zone. With a breakout, your target profit should be the next support or resistance zone. Now that you know much about support and resistance, let's test your brain here. Remember to let us know how much you scored. 1. Identify the best key support or resistance, A, B, or C. This is our major level. 2. Price approached here. You're an aggressive trader. What do? You sell. 3. In this scenario, where do you place your target profit and stop loss? 4. Price reached here and broke our support level. You're a conservative trader. What do? You wait for price to pull back and enter the market. 5. Where do you set your target profit and stop loss? Here, because that's our next support. The higher the time frame, the longer you will wait for price to get to your support or resistance. So for a scalper, 15 to 30 minutes time frame is ideal. For a day trader, 1 hour time frame is ideal, and for a swing trader, the 4 hours and daily time frame is ideal. However, this doesn't mean a scalper can't trade a daily support or resistance zone if price gets there. You don't need to go back 5 years to find support and resistance levels. Most of the levels that you will need are going to come from highs and lows that have occurred within the last 6 months. Feel free to travel back in time once you have the level drawn, but don't think it is necessary to look back more than 6 months to find great levels to trade. To maintain a clean chart, be sure to move your support or resistance zone further to the right as the touches in that zone increases. Breakouts are sometimes false, and bounces even after candlestick formation don't always work. You won't always win trades, but the risk-to-reward ratio in trading support and resistance can make you profitable. Remember to apply proper risk management. Another easier way to identify support or resistance is to look back at the chart to find a significant pause in a price decline or rise. Then look forward to see whether a price halts and/or reverses as it approaches that level. Price may break through support or resistance aggressively, leaving you behind, but it's normal as you can't catch every trade. The hanging man pattern is similar to the hammer candlestick pattern. They both have a short body, and they are characterized by a long lower shadow and a little to no upper shadow. The colors of the body doesn't really matter, though a red body is more bearish and a green body is more bullish. However, the key difference is the hanging man is found only at the top of an uptrend, while the hammer candlestick is found only at the bottom of a downtrend. Simply put, if a hammer candlestick pattern is found at the top of an uptrend, then it becomes a hanging man candlestick pattern. Example, as you can see in this chart, the hanging man formed at the top of an uptrend, communicating that there might be a change in trend. Therefore, we enter the trade. And in this chart, the hammer candlestick pattern formed at the bottom of a downtrend, which signals the possibility of a trend change. Therefore, we enter the market. This example shows a hammer candlestick, but since it formed at the top, it is considered as a hanging man candlestick pattern. If you've made it through to the end, I admire your determination. If you would like to get more clear and concise teachings in trading, don't forget to like, comment, and subscribe to my channel. Have a great trading week.